If you had been subscribed to more than one finance YouTuber over the past week, your YouTube home screen would have been filled with news about the spring budget. The budget is a very boring financial statement given out by the Chancellor of the Exchequer, who is Jeremy Hunt currently, and in it the government outlines some important changes to the nation's finances and the government's proposals for changes in taxations for the nation. So just to recap, a few key things were mentioned in the budget, although it wasn't as big as people had expected it to. One good news is that national insurance is going down from 10%, which was already reduced from 12%, down to 8% from April. They are also getting rid of the non-dom status, who many have benefited from paying less taxes, and now there are higher income thresholds for people who are claiming child benefits. However, as you know, this is a personal finance channel and we really only care about investing here. There was one particular announcement or proposal that every finance YouTuber latched onto, and this is what I want to talk about in this video. This is of course a higher proposed increase to the total amount we can deposit into our ISAs. And this comes in the form of a new ISA, which is called the UK ISA, and on YouTube everyone is calling it the British ISA. So for those who don't know, ISA stands for individual savings accounts, and they have been out for quite a while now. Any money that you deposit within these ISAs, any subsequent gains, capital gains, dividends, interest, anything like that, is completely tax-free, making it the most powerful single tool at our disposal for UK-based investors. However, the government is now looking to introduce something called a UK ISA on top of the ISAs that we already have, such as the Stocks and Shares ISA, the Lifetime ISA, the Cash ISA, and the Innovative Finance ISA. I am aware that there are some mixes of those that already exist, as if it wasn't confusing enough. But this new British ISA or UK ISA has an allowance of £5,000 extra in addition to our £20,000 that we have for our other ISAs, and in it the premise is that we can invest £5,000 tax-free as long as the majority of these investments are within UK companies. So what exactly do we know about these plans? All we can say for certain right now is that, these plans aren't made concrete yet. In fact, what they've done is that the British government has actually outlined a consultation document, and in it they have a few proposed key information points that they want the public to actually look at and give some feedback, because ultimately such a new ISA is going to have a lot of workarounds and it's going to be quite difficult to actually apply and make sure that it is fair for everyone, because of course applying something like only British stocks is a very loose definition, and we know that when things aren't defined properly there can be a lot of loopholes and a lot of way that people can be winning and losing at the same time. There's also a lot of costs in introducing such a scheme, so of course the government is still looking to actually complete all these prerequisites before they can actually release the ISA. So it is very unlikely that the ISA is going to come anytime soon, maybe in the next tax year starting in 2025. So if we look at this document, the consultation, there are a few key terms that I actually want to go through. So if we look at chapter 2 of the consultation, we can see how they define the UK ISA. So if we go under shares in UK companies, we can see that there are a number of definitions that the government could draw to define these UK companies. Technically, even if you invest into a company that is listed as a UK company, they could be operating worldwide, meaning that some of their profits come from companies all over the world, so that if their company grows in value, so do these other countries benefit off of this increased value and increased trade. So defining what a UK company is actually very difficult. One of their proposed definitions for finding a UK company could be the fact that they are listed on a UK-based stock exchange. So here they recognize exchanges such as the Aquis Stock Exchange, the CBOE Europe Limited Stock Exchange, and of course the very famous London Stock Exchange. This also includes the part of the London Stock Exchange called the AIM, or the Alternative Investment Market. So of course by doing this, by allocating £5,000 more tax-free, gives the people of the UK more incentive to actually invest into UK companies, and as a result the hope is that these companies will become a lot more valued because a lot more money is being pumped into the system, and of course that helps grow the UK economy, and any investment that we have now only benefits the future, or at least theoretically that's what it is. So of course having a UK ISA, in theory anyway, will support lots of small, medium and large businesses in the UK, and if they are listed on, for example, the London Stock Exchange, any company company listed under that could be recognized as a UK company, and it makes ISA providers such as InvestEngine or Trading212 to easily define what a UK based company is, and when they open the UK ISA it is so much easier in terms of admin to actually allocate certain companies to that UK ISA, creating a lot less of a financial burden to create these ISAs, giving them more incentive to create these ISAs, because at the end of the day £5,000 per year isn't a lot for a lot of these providers to actually open a dedicated British ISA and all that cost that comes with opening and maintaining a British ISA. So one of the other ways that they could define what a UK based company is if this actual investment has at least 75% of its value held by the fund, where those 75% are invested into eligible UK companies. For example, this extends to things like ETFs. For example, something like the FTSE 250 or the FTSE 100 should of course be compatible with this new UK ISA, as the majority, if not 99% plus of these companies can be considered as UK based companies. Other things that they are considering to put into this UK ISA are of course corporate bonds. So there are two main types of bonds: corporate, meaning from actual companies, and then there are government bonds, which they actually outline here as well. But corporate bonds are, an IOU from a company that raises money through bonds. So when they issue a bond, essentially they're borrowing money from the bond holder and they will give interest on top of that. Gilts are pretty much the same, but they are issued by governments instead of corporations. And of course, UK bonds as well as US bonds are very, very high quality in terms of their government bonds. So of course, a lot of people, especially when you get older during your investing journey, a lot of your investments are going to be held in bonds. So if you can keep another £5,000 extra in terms of government bonds into UK government anyway, so that is a very huge pro for them, and essentially is going to bring more money into the UK economy. So in terms of cash, I know a lot of brokers such as Trading212 for example, they currently give 5.2% as an annual equivalent rate paid daily on uninvested cash. If you want to sign up to Trading212, use the link in the description down below, or even have a promo code if you've signed up recently and haven't received a free share. But anyway, cash investments are not going to be allowed into the UK ISA because of course getting 5.2% guaranteed on just cash doesn't actually help the UK economy at all. So it is likely if Trading212 for example opens up a UK ISA that you actually will not get any interest on your uninvested cash. So that cash has to always be invested into some sort of UK company at any given time. This actually does make a lot of sense here. Chapter 3 quickly goes over the design of the UK ISA, and as we know, we'll have an additional £5,000 allowance just for this British ISA. As with current ISAs right now, if you don't use your allowance, you do not ever get that back and you can't roll over it to the next year. Unless it is a flexible British ISA, if you take out £5,000 for example, for the remainder of that tax year, you technically should not be able to actually put another £5,000 back in. Going forward from April the 6th, the government has outlined that you are now able to invest into more than one stocks and shares ISA or any other type of ISA per tax year. Up until now, including today, you can only have one type of ISA per tax year per provider. But of course, there's no reason if they've applied that to every other type of ISA why they can't apply that to a British ISA. When it comes to transferring money between ISAs, there will be some restrictions on actually transferring from a UK ISA to your normal stocks and shares ISA, for example. Here it says that transfers from a UK ISA to another type of ISA will not be permitted, which does really make sense. This is because you can get an additional £5,000 per year just sitting in your ISA waiting to be transferred into your main ISA, which in the eyes of the British economy is not going to really help because you're just waiting on the end of the tax year to transfer that amount. In terms of holding cash, there is a possibility that you can still earn interest on uninvested cash. However, the interest from this cash in this British ISA could be taxed at the normal personal savings allowance tax, which could prove to be a very big nightmare for the UK ISAs. As we all know, all ISAs are tax-free no matter what kind of interest you're gaining, whether that's capital gains, dividends, or even interest. So introducing an interest on uninvested cash that you then have to self-report to HMRC could be incredibly frustrating for the majority of people. I think it is better just to not add interest on the cash so that people aren't, having to separately do self-assessment forms. Or the government, due to their new digitalization of ISAs, they should automatically take this amount of interest and then tax it through, your national insurance number instead of having to do it manually. This goes on to the point of existing ISA rules. In order to maintain consistency throughout all the different ISAs, all the tax benefits are going to be remaining the same. This means that you can withdraw your money pretty much whenever you want within 30 days. But also, just like I said before, if they start charging tax for interest gain on uninvested cash within an ISA, it could really throw off balance of what people think of the ISA, and I don't think that's a good idea personally. So chapter 4 just goes through how they might deliver it and the kind of compliance behind it, and in terms of timelines, they are actually ironing out all the creases on that. So yeah, it will take quite a bit of time for the British ISA to actually come to fruition, if it ever does that at all. And there's a line here about the UK ISA and digital reporting, which of course could mean that all your ISAs get reported to HMRC, although you don't have to pay tax. If they do start introducing tax, which they might do, hopefully never they will do that, but you know, they can easily work out how much tax someone is liable for because all this data goes straight to HMRC. So what do I think about the British ISA? Will I ever use it, and how would I use it if it came into play from April the 6th? I personally think this is a great idea. Any addition to my ISA limit or allowance, I am very happy for. I have been lucky enough to max out my ISA every single year since I started investing back in 2021, and I am someone who can actually max out my main ISA and still have a bit left over, so I am very welcome to any additions. I definitely will be using the ISA if it does come into play, and I have a specific way in which I would actually invest into the British ISA. So of course, the £20,000 normal ISA stocks and shares for me is going to be maxed out as soon as possible when April the 6th actually comes into play. And then if we had the British ISA, I would actually just use it to invest into the FTSE 250. If platforms such as Trading212 had this, essentially what I would actually be doing personally, although I don't recommend it, is actually be trading with the FTSE 250, as it has a very high volatility and I believe there's a lot of money to be made, and £5,000 will be a perfect amount, not too much, but a perfect amount to actually have fun with actually trading in the FTSE 250. In addition, you can keep the money into something like the FTSE 100, which has a very high dividend yield, and of course you probably would be making more money than putting your money into the bank account, as the Bank of England actually reduces the central rate. In terms of individual stocks, I personally will not be investing in any individual stocks, so I will rather stick to ETFs. I would be very happy to put my money into ETFs that, you know, are now designed for the British ISA. Maybe they have 75% British stocks and then 25% throughout the rest of the world. I would be happy to put £5,000 a year into that. In terms of government bonds, I'm not sure how the bond market will fare in the next few years. Bond yields might just start crashing again. So yeah, I personally would want to put my money into an ETF, for example, the FTSE 250. And if you're allowed to trade, which I see no reason why you can't, then I would definitely be trading the FTSE 250 just for a bit of fun. If I can make more than £5,000 into that, whatever gain I make is going to be tax free. And of course, even though I can't transfer from a UK ISA to my ISA, I can always withdraw that money and then manually put it in my ISA, because my priority will always be to max out my £20,000 stocks and shares ISA, always in the beginning. So make sure to check out some of my other videos, and I'll see you in the next video.